I'm Richard Evans, a professor of finance here at Darden, and it is my distinct pleasure to be speaking with Richard Chilton today. Richard, thanks for joining me.
You're welcome.
With over $9 billion in assets under management and an impressive performance track record, can you tell us a little bit about your investment philosophy?
Sure, Rich, I'd love to, and thank you for having me here. We try to find great businesses that we think are great business models that have the sustainability over many years, that have the ability to price their product, that generate huge free cash flow, that have a moat around their business, and a moat to be defined as a barrier that would enable a company to be able to sustain economic disasters and competition like creative destruction. And once we find those businesses, we like to use market volatility, both individual stock volatility or market volatility, to create good entry points.
So when you think about analyzing a business and the quality of that business, how important is management and their capital allocation?
It's really important. You know, so many companies, I mean, I think there's two important things for a CEO to do: find his successor and allocate capital wisely. Yeah. There's so many companies that have been littered because of poor capital allocation. Look at HP, for instance. Yeah. You know, started a great company, had just poor DNA in the boardroom that took good money and from good businesses and put it into bad businesses. And over time, it just destroyed the company. So that boardroom DNA of reinvesting in their own business, which is a great business, is critical. Return that cash back to the shareholders.
Yeah, I've heard you use Coca-Cola as an example of the opposite phenomenon of good management decisions in terms of capital allocation.
Yeah, well, when Roberto Guazzetta came aboard in 1981, Coke had a disparate amount of businesses. Yeah, they had their old Coke, but they also had shrimp farms, and then they just later, a couple years later, bought Columbia Pictures, non-synergistic businesses that were distractions. And what happened when they started to peel those away and focus on their base beverage business and return that excess cash? Their stock went up 20-fold.
So if you look for these companies, are there certain industries where you find more of them than others?
Yeah, fishing in the right waters is key. You know, we look at the durability of the cash flow return on investment, and there's a real pattern that evolves there. Yeah. And that pattern is focused on industries that have consistency to their cash flow return on investment, right, and others that don't. And the lower probability companies or industries would be companies like technology, real estate, semiconductors. There are just not a lot of good businesses there.
Yeah, and is it, for those businesses in particular, is it the mode? Is it, I mean, what really makes them so difficult?
A lot of them is they don't have the durability of the model, which means that they're susceptible to poor business economic climates, they're to pricing, to GDP, and creative destruction, which is just rampant in all businesses. You know, Warren Buffett says that when he wakes up every day, he wants to know that people have had, you know, a lot of Cokes during the day. And I say is that I want to go to bed at night knowing that there's billions of people around the world that are going to brush their teeth with a Colgate toothbrush. That's good for me.
So when you look at these businesses, right, they're good businesses, these tend to be good brands. At the same time, price may be high. And you said you use market volatility. Yeah. How do you know when's the right time to get in?
Yeah, you know, just identifying a good business model is not enough. Yeah. You need to marry that with the right entry point. And so what we do is we look at their economic earning power and we look at it over a 3 to 5 year period, apply a multiple that we think it'll sell for, and then discount it back at 25%. Why 25%? Because we make mistakes and we want to give a margin of safety. And discounting it back will tell us what's the right price to pay today.
Absolutely.
And we wait, we're patient.
Yeah, so thinking a little bit longer term, a little broader scope, you've been in this industry for a long time. When you look out 10 or 15 years, what are the opportunities and the challenges you see for investment advisors?
Well, I think that, you know, there's a lot of Me Too investment advisors. There's a lot of people who don't deliver alpha. And the wind has been at the investment advisory back for a long period of time. And now we're in the tougher days where it's separation time. And that separation of the good from the mediocre is happening. So it's in effect our own creative destruction. where only the good ones are going to be able to survive. And that's the whole reason why you've seen the ETF business go from nothing to 2 trillion. Because those